all the speakers have been given an invite, so just accept the invite, or if you don't see it, just go to your DM and you can get it there. Okay, so we have Michael and Daniel on, we're just waiting for Yra and Mark.
You need some background music, Tracy, I think, just something like elevated.
Just something so it's not dead silent. I know, I'll put the music on next time.
What's your favorite song? Put your favorite track on.
I really have one right now. I don't know, it's too early for some hard rock, so.
It's never too early for hard rock. Hey, Daniel, are you a hard rock fan? Because it's not the morning where you are.
Yes, I'm a huge music fan, huge rock fan, and a huge hard rock fan. So there you go. Here in front of me is I have about 35,000 CDs around me right now.
35,000?
So that would be a
That 35,000 including vinyl. Yeah, it's pretty insane.
And that's your collection. And
that is my collection, yes.
Wow.
So I still buy physical format, which is stupid, I know, but I like to collect rare editions and stuff like that, you know, and so I don't know how many different versions of some of the albums I can have, but I'm just looking in front of me. One of the bands that has ripped me off more evidently is Black Sabbath, which I'm seeing. I have at least 3 different versions of every album.
You are a true investor. You are a true investor, Daniel.
Yeah, exactly. So, you know, they say, oh, definitive remaster. I got that. Definite remaster deluxe. I got it. Deluxe version. I got it. Box set. I got it. And, oh, you know, so I'm basically paying the pension of Ozzy Osbourne and friends.
Okay. All right. So Mark is up. Mark, can you just mute yourself? Yeah, other people are speaking. And then we'll start. Yra is coming. I just got a DM that said he is coming in a few minutes. So I'm going to go ahead and start now. So, hey, everyone. I want to thank you for attending the Place Your Trades Network Spaces covering the oil and bond markets and global macro energy environment. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts to trade crude oil and natural gas indices and metals. You can use the link on my Twitter stream to go and get the TraderBait app for free. Also write a weekly blog on Place Your Trades on energy and metals that you can find at placeyourtrades.com. And then over the next month, Place Your Trades is giving away a trip to Vegas. So one winner will join the PYT team for the Money Show, April 24th to 26th. All you have to do is go to placeyourtrades.com/Vegas to sign up before March 1st. And then on March 1st, there will be a special show to have a drawing for whoever wins the trip to Vegas. And I'll put the link on my Twitter stream as well. All right, so our guest today, we have Mark Oswald, who's Chief Economist and Global Strategist at ADM Investor Services International. He has 38 years experience in FX, fixed income, commodities, equities, and asset allocation, EM and DM, and a deep understanding of macroeconomics, central banks, geopolitics, global supply chains, and regulation. He's a regular on TV, as well as huge conference speaker. So some of the events he will be in this year are Gulf Intelligence Virtual Year Ahead Energy Forum 2023, Argus Paris Grains, CTW Power Trading Europe, CRU Phosphates Conference Energy Trading Week, Global Grain, Fujairah Energy Markets Forum, and the Baltic Dry Exchange Freight Forum, just to name a few. Then we also have Daniel Lacalle. Daniel is a PhD in economy and a fund manager. He holds a CIIA financial analyst title with a postgraduate degree in IESE and a master's degree in economic investigation. has more than 24 years of experience in the energy and finance sectors, including experience in North Africa, Latin America, and the Middle East. He's currently a fund manager overseeing equities, bonds, and commodities. He was voted top 3 generalist and #1 pan-European buy-side individual in oil and gas in Thomson Reuters Excel survey, and one of the leading surveys among companies in financial institution. And he's also a best-selling author. You can go to his website and see his books there. Next, we have Michael Gayet, which I'm sure everybody knows because he holds about 1 billion spaces a week. So I thought I would have him be a guest on our spaces for the first time. He is a portfolio manager at Tidal Energy Group, an investment management company specializing in ETF-focused research, investment strategies, and services designed for financial advisors, RIAs, family offices, and investment managers. Prior to Tidal Financial Group, Michael was a co-portfolio manager and chief investment strategist at Pension Partners, LLC, an investment advisor managing mutual funds and separate accounts. He's also the author of 5 award-winning research papers on market anomalies and investing. He's also a CFA chart holder since 2008. And then we have YraHarris, who hopefully is going to get up here soon. Yra's been in the market for decades and is an icon in the industry. I will let him tell you a little bit more, but I do want to mention that he writes a note called Notes from the Underground that is fantastic, that he posts to his Twitter feed. So I would highly recommend that when he goes and posts those. They're kind of more geared towards bond investors, but a lot of macro stuff in there as well. All right. So welcome, everybody. Thank you so much for coming. So I'll start with Daniel. And first, I kind of want to talk a little bit about the macro landscape in energy markets. So we've seen natural gas prices plunge globally. The market seems to be pretty placated right now with storage full and a very mild winter, particularly in Europe. And it seems the market's discounting any future crisis in Europe. So I kind of wanted to get your broad overview on the European energy markets. And in particular, do you see this crisis over, or are we just in a holding pattern right now?
Thank you so much, Tracy. I think that we're in a holding pattern, basically, because the only reason why the Eurozone, the European Union, has escaped a recession and a deep energy crisis is because of a very mild winter. It's true that inventories are elevated and that that has also cushioned the blow of the energy crisis, but that doesn't transfer to the household bills. The prices that people are paying are much, much higher than in 2020 and 2021, not just because of what we have seen in commodities, which has been a U-turn since June, but because you have to add the CO2 tax, you have to add all of the regulated costs and subsidies, etc. I spoke recently with one of the largest utilities in Europe CEO, and he said to me that he wasn't worried about winter, that he was worried about summer, because it is in summer when the tensions in the energy market in Europe become more evident, because obviously there is much higher demand for air conditioning. There is also more activity in the manufacturing sector. And there is certainly a big risk because we have a very volatile and intermittent energy mix because of the high percentage of renewables that work about 25% of the time, no? So I think that in overall last year, what we saw was global commodities U-turn in the second part of the year because of the Chinese shutdown and the rate hikes, which both have significantly impacted commodity flows and commodity imports. But as we are seeing now, the China reopening is bringing back a lot of demand in a very tight environment because inventories remain below the 5-year average almost in every single commodity that we look at. And at the same time, the supply challenges have not been eased in any significant form. So I think that, again, I think that the crisis has been postponed more than averted, no?
Oh, absolutely. I totally agree with that. In fact, you actually talked about a lot of the questions that I had. I wanted to, I mean, that's what I was, I cannot talk today. So exactly, I mean, first of all, we're not really seeing inflation numbers fall that much, right? UK food inflation just came in at 16.7%, Euro area core inflation still at a record 5.2%, but everybody seems to think that there's going to be no recession.
Yeah.
Do you think, again, do you think analysts or the market's getting too placated just by saying, because these energy prices have come down or because that gas has come down, and nothing else is moving?
Way too complacent. The market is way too complacent about the Eurozone. If you look at the GDP figures published by the leading economies, household consumption is down, investment is down, exports are down. This is important because the Eurozone is an exporting region. And the reason why GDP has not slumped is because government spending is massively up and imports are much lower. No, so obviously the contribution of the external sector to GDP, even though exports are weak, is positive because imports are weaker. No, are weaker. So people are being very, very complacent. They're not seeing that the trend is very worrying. It is the 22nd consecutive month of contracting PMIs in the manufacturing sector. This is not something that is due to the Ukraine crisis, etc. Very few people. There's a narrative, obviously, that it was COVID first and then the Ukraine war, and that all of these are exogenous problems. In the fourth quarter of 2019, before any of these problems had arrived, Germany was on the verge of recession, France was in stagnation, Italy was in stagnation, Spain and Portugal and Greece were in deep contraction. So this is not a problem of just these external factors that affect other economies. And I think that the expectations of a strong bounce in European economies are basically misinterpreting the signals of what, again, is yet another exogenous factor, which is simply that I'm looking out the window, it's a beautiful day, and it's extremely mild. So not January, no, sorry, not 1st of February type of weather. No, remember that last year, precisely to this day, there was a massive snowstorm collapsing many roads in this same area, no?
Yeah, absolutely. Absolutely. Totally agree. So we will come back. I'm going to make the rounds, and then so everybody gets a chance to talk and nobody's sitting around. But if anybody has a comment to any other speaker's comment, please feel free to jump in. So we'll move to Mark. Mark, we talked about this a little bit on DM, but there's obvious disconnect right now between falling inflation break-even yields that are assuming a sharp fall in inflation and surging oil prices, particularly given that spec paper position has turned overwhelmingly bullish. It seems that both cannot be right. What are your thoughts on this disconnect?
Well, I mean, I think the falling bond yields owe much to what I'd call wishful thinking, and of course, the fact that we are so focused in terms of central banks on what they're doing with rates, and we keep on ignoring the fact that we've still got this massive overhang of all the liquidity they injected. And yes, the Fed has started reducing the size of its balance sheet, So has the Bank of England. It's even actively selling gilts. The ECB hasn't even started. And I still feel that is actually something which is going to come back to bite people. And there's a little bit too much of a consensus trade out there, which just says, well, bonds had such a bad year last year that they've got to do better this year. Well, that really depends a lot on what happens with the inflation story. Equally, on the other side, with the oil story, it is there are structural problems. The fact that we've seen lower demand owes a lot to a lot of the headwinds out there. But I think right now, the concern is, one, you've got OPEC Plus making a very clear signal that even if demand does pick up and things aren't as bad, which is going to be bad news for bond yields in any case, because if we aren't going into the recession that everyone keeps on saying that we're going to go into, then bond prices are at the wrong level. And the idea of a Fed pivot is also the wrong idea. So somewhere along the line, the only primary concern there is that we have had a huge addition to bullish positions on oil products, in contrast to natural gas. So I always worry when we suddenly get the paper market suddenly charging into something in commodities, because we know how poor liquidity is. And I think that's the other point at the moment, really, that a lot of these movements that we're seeing in bonds, equities, even FX markets, is down to the excess liquidity. On the other hand, it's also down to very, very thin liquidity. And any market that you look at, you see a sort of trend developing, and then in a matter of hours, it can absolutely be turned on its head because the market depth is just not there. So I rather think that people looking for guidance from markets, be that on inflation, be that on oil prices, need to be a little bit careful about over extrapolating about what markets are saying about the economy, because I really think that a lot of it is just a function of very thin liquidity.
Oh, I absolutely agree with that. I mean, particularly the energy markets have been awful. And, because of that, we've seen kind of a disconnect between the physical markets and, say, front month prices, right? And, do you think that's just a function of liquidity, or, why have we been seeing this big disconnect over, the last 6 months or so?
I think the disconnect is partly because markets dine out on hopium the whole time. We've talked about, over my many years in markets, the Widowmaker trade was always people betting against the Bank of Japan. I rather think that markets, we've been tripped up more than a number of times over the last 6 months by the Federal Reserve, to a certain extent by the ECB, are just basically taking them on yet again, and probably going to be finding themselves in a fight which they'll lose yet again. And I think that's really where the big concern is, that we get, as liquidity gets thinner and thinner, as the cost of hedging positions in markets has become so high, largely due to higher financing rates, we are in danger at some stage of seeing a lift shaft type movement in markets, because there simply isn't the protection there that there was, other than by very, very short-term options trades, which is keeping short-term volatility down to a certain extent.
Yeah, absolutely. Absolutely. So we'll move on to Michael. I want to talk to you about, there's been obviously increase in oil prices over the year, and it's also been kind of accompanied by a rise in the 10-year U.S. Treasury yield. Do you think there is anything to this correlation, or it just happens to be happenstance? I know that you've talk a lot about bonds. So maybe you could give us some color on that, and if you see it correlated to energy at all.
Yeah, no, I always go back to this point that path matters more than prediction. It's not about the endpoint; it's about the dance in between the raindrops when it comes to trading and active management. A couple of things, and I want to hit on this point. So, this is sort of a very well-known intermarket relationship. And for those that are in the audience that are not familiar with what intermarket analysis is, it's a branch of technical analysis. It says that what you're looking at matters, whereas true technicians don't really care what the chart they're looking at represents. Those that adhere to an intermarket approach basically think that whatever your chart you're looking at matters a hell of a lot more than just looking at support, resistance, so on and so forth. One of the sort of classic intermarket relationships is that of the relationship of oil prices to bond yields. So usually when bond yields are rising, that will coincide with oil moving in advance. Why? Because oil is a form of cost push inflation. Bond investors seeing that then start to demand more of a premium on their yields. So there's a sort of a delayed effect. Oil will tend to move, and then bond yields through the inflation expectations mechanism will respond. So it should make sense, right? That as oil has fallen, yields have fallen with a lag. I think oil peaked, correct me if I'm wrong, in late May, June, and bond yields peaked, only a few months after that when you look at the 10-year Treasury. There is a point, though, I think, which is worth mentioning along the lines of what Mark was saying, because I believe we're in call it a melt up. I call it a melt up, but I believe the conditions are there for a surprising move higher in the here and now. But I keep going back to I myself am of the mindset that at some point, maybe this year, there's a credit event out there. Daniel Lakai had put a great chart, we should also touch on, around the percentage of new loans that are maturing next year, suggesting that there's a lot of rollover risk next year in 2024. When would the stock market start to react off of that? In 2023. When would credit spreads start to react off of that? In 2023. I think that's a story down the line. So the point about what Mark mentioned around the bond market, I think, is really interesting. Last year was unusual in that it was a shift in bonds. It was not a credit crisis, it was a duration crisis. So you ended up having one of the worst years in history for the bond market, and the complete abject failure of the flight to safety trade in treasuries, which has been the hell for my own funds that I manage. I suspect you could have another really bad year for bonds, but not in the way that we saw last year. Meaning, if last year was the duration crisis, this year could be the credit crisis. So if we're going to talk about the idea that bonds suffer again, to me, it's not so much about a question of whether inflation is going to pick up or not, or what's going to happen with oil. It's a question of default risk. Is the market going to start to be concerned about, to Mark's point, the recession everyone's saying is coming, that credit spreads are not reacting off of just yet?
Yeah, I mean, I think that's a kind of been a common fear, common thing among a lot of people on Twitter, a lot of analysts on Twitter, that some sort of credit event is coming. So that makes a lot of sense. I kind of wanted to move on to USD a little bit. Obviously, USD impacts commodities quite a bit, particularly energy and metals. Do you think that this spike is over? Because we've seen the dollar come down quite a bit, right, over the last few months. Do you think that spike is over, or do you think there's a scenario in which we could see a USD spike again? Because, as the dollars come down, we've seen a lot of money pour into emerging markets as well. And if the dollar spikes again, that's going to be a really bad trade. So what are your thoughts on the dollar?
Yeah, no, especially this is a good point. So, I mean, one of the other unusual dynamics of last year was you had the flight to safety trade in the dollar, not in treasuries. And typically, when you have high volatility in equities, it's not my opinion, you'll see money flow into long duration government debt. Yields will drop, or at least lose less in terms of them rising and price going down, and you'll see the dollar itself rise. Now, it's funny because I kept on tweeting out these, I think it was either NSYNC or Backstreet Boys, the Giphy of buy, buy, buy when the dollar was going through distribution. And I said the dollar finished, and the dollar then had a pretty big sell-off. If you have a credit event, I suspect you're going to see the dollar rise pretty meaningfully alongside treasuries to reassert that flight to safety dynamic. it is intriguing though, because I keep going back to this broader, very, very long-term cycle thesis, which is that, and I've used this line on Twitter before, some people seemingly don't understand what I'm trying to say, the death of QE is the rebirth of emerging markets. And that factors into the dollar in the sense that, it's not my opinion, you look at the distribution of returns on the S&P, you compare them against international, in particular emerging markets, the effective QE3 and zero interest rate policy is it cut off the fat left tail for U.S. stocks, meaning you did not really have high frequency with larger declines, which is what you normally see in looking at the return pattern of equities. That dynamic maintained for emerging markets post QE3. It did not was not the case post QE3 for U.S. stocks. You don't have QE. We can debate whether it comes back or not. You don't have a zero interest rate policy. You've now leveled the playing field. So the left tail fatness, so to speak, in the distribution for international stocks, for U.S. stocks, now looks the same. You level the playing field, valuations start mattering again. You level the playing field, all the money that went into the U.S. stock market for the last decade now is going to look somewhere else. So I say that in the context of the dollar, in the sense that it wouldn't surprise me if higher rates, oddly enough, forces money out of the U.S. as it seeks cheaper opportunities where valuation matters because you don't have the unfair advantage of what QE and ZIRP did to the S&P 500.
Yeah, do you think this affects energy flows, or or are we just talking equity markets here?
Well, yeah, it's interesting, right? I mean, if you're going to be, I'm going to argue that if you're going to be dollar bearish, if you're going to go on this thesis about emerging over U.S. from a multi-year perspective, right? Most people are only going to realize it 2 to 3 years after, because that's how cycles work, right? You don't realize the cycle's changed until 2 to 3 years after the cycle's changed. You don't have momentum until there's momentum, which is kind of the paradox of momentum. But if you're going to believe in that thesis of emerging markets over U.S., that means you have to inherently believe in the thesis of value over growth from a multi-year perspective, because it's ultimately about sector composition, which would include energy as part of the value play. And if you look at energy divided by technology, you look at the XLE ETF divided by the XLK ETF. On a side note, it's interesting, if you look at the amount of assets that energy gained in the State Street XLE energy ETF, it's around $10 billion last year, which is roughly the same amount that XLK lost. Just more of a side note. If you believe in these longer term themes around commodities, around energy, around the dollar weakness, around emerging markets, you probably have to believe the dollar itself on average is going to be a lot lower. But again, you have a credit crisis. I go back to path matters more than prediction. The dollar will probably do what it typically does, which is come right back.
Well, and thank you for that. So Yra's having a little problems getting on, so I'm going to go back to Daniel. I kind of wanted to get, obviously, there's a lot of talk about China demand right now. China's coming back, but we're still seeing, a lot of Russian barrels on the market still. Many analysts were, expecting 3 to 4 million, and we're obviously seeing none of that. They're still flowing. So what do you expect? Which kind of leads me to a diesel question. It's kind of a two-part question. One is your thoughts on China demand coming back. How quickly do you think that demand will come back? I know that, say, the property sector is still a disaster zone, but they're the largest EV car maker, so that's kind of referring to metals demand on the EV question. But what are we looking at as far as demand coming back for, make it two separate topics, one for energy and one for metals?
Hi. So the point that I make about the Chinese recovery is that you have to look at the glass half full and half empty at the same time. The Chinese recovery will not in any shape or form be a recovery to the levels of imports that we saw in 2019, 2018, for a very simple reason, is that, as you very well mentioned, the housing sector is not there. The housing sector slump and the real estate bubble burst in China needs to be viewed from the perspective of a multi-year challenge that is certainly not going to drive the level of imports that we saw before. However, on the glass half full side, what is also true is that there is a level of demand, for example, for copper and for gold and for other precious metals that is essential for many of the debtors to provide some form of collateral to new debt in China. So there's added demand, not just on the industrial side, but also from people that need to use copper. And was a very big thing in 2016-17. You need to use copper as a collateral for loans that would otherwise not be provided in the same conditions. So industrial demand in China will likely go back to expansion within the next 5 months. The level of growth in China is likely to be closer to 4.5, 4.7%. It could even reach 5%, but it's not going to be 6%. This is, in any case, bullish demand side for the world of commodities, energy commodities, and precious metals, because the Central Bank of China is buying more gold. Creditors in China demand more precious metals as collateral, and at the same time, industrial demand is likely to pick up, but it's not going to pick up to the levels seen prior to the slump of the real estate bubble, because it was the largest impact in terms of rising or surprise marginal demand in the years of building anything at any cost.
So your timeline on that is, just to clarify, so your timeline on that is within the next 5 months?
Yeah, I think that we would likely see in the next 5 months China going back to expansion territory in the manufacturing and industrial side. I think that at least is what we get out of our Asian intelligence part, that a lot of businesses are starting to come back, and that many factories are starting to come back to a workload that is almost 30% higher than that of November, December. So I think that in general, all of those elements, the part that I think is more interesting about all of that is probably not going to create massive imbalances in many of the commodity supply-demand scenarios, which have already built some form of recovery of Chinese imports. I think that the key is in LNG, in liquefied natural gas. I think that market is currently perceived as much more ample and much stronger than what it actually is, and a very, very modest improvement in industrial demand from China is likely to tighten the global liquefied natural gas market in a very, very sharp and quick way.
That leads me to another question, actually. So right now we're seeing JKM, which is Asian nat gas, for people that don't know, starting to trade higher than European natural gas. So with China coming back online, it seems likely that cargoes are going to be diverted to Asia. Is this going to be a problem for the EU? I know that stocks are full now, but come this summer.
Yeah, absolutely. Absolutely, it will. I said it before. It's not a problem of this winter, which is extraordinarily milder all over Europe. I just came back from the Netherlands, from Germany, from gosh, you even go to Finland. You can even go outside. No, it's unbelievable. But not unbelievable. It's La Nina year, but. But the problem the problem of LNG is going to be a buyer's market in a very short period of time. In a very short period of time, for a very simple reason. U.S. producers have limited available extraordinary capacity to export, while demand is improving, and so it's either going to be a question of security of supply or price. And I think that if you have to choose between security of supply and price, it is China that's going to win. In that environment as well, the European Union faces a problem. Is that the European Union has basically disguised its Russian dependency problem by, I kid you not, uh, considering that the imports of Russian gas from Novatek is not Russian gas. We have seen that in Portugal, in Italy, in Spain, etc. So there's going to be a very significant challenge at some point, because none of the structural problems of a of having a volatile and intermittent energy mix that demands either significantly more coal or significantly more gas when wind power and solar are not working or are working below expectations. And if we go into summer with a low level of hydropower production, then it's going to be an even larger problem. So all of those structural problems have not been solved. The only thing that has changed, I come back to the point I made earlier, is that it's been a very mild winter, and that the US has exported significantly more gas into the European Union than was ultimately needed when demand actually kicked in. But that is not likely to be the case if China, uh, going from contraction 48 PMI to 50 PMI in China means literally that the tightness of the LNG market globally becomes severe from quite tight as where it is today.
Thank you. You kind of wanted to move to Mark and kind of ask you the same question. What are your thoughts on China and China demand increase as far as energy and metals are concerned? And do you have a timeline on that as well?
Well, I think that the whole story around, well, Europe versus China, because it's essentially that's what this is, a face-off in the gas market about, and Europe got away with, not only a cold winter but also a long period of low Chinese demand. We're now at the stage where Europe has secured the supplies, but I think there's sort of two issues which worry me on the gas side. Is people seem to think that, well, particularly politicians, that you can just redistribute LNG in the same way you distribute the Russian gas, which you can't. It's going to be more expensive. That's bad news for Eurozone inflation. It's bad news above all for European businesses. I still think there's a big risk of deindustrialization in Europe, which in turn also basically is another inflation pressure, because the more it has to import, because the cost of production is just uncompetitive. We've seen it from BASF announcing that it's permanently going to reduce some of its activity at that colossal plant in Germany, and the whole subsidy story in Europe. We keep on seeing it with the inflation numbers. Most of these inflation numbers that we've had, they've been better than expected, but underlying all of that, you then actually have a look at, say, a little breakdown of European CPI, and you see that the worst part of it, ironically, at the time that US inflation is coming down due to goods inflation dropping quite sharply, in Europe, actually it keeps on marching higher. Now, it will come down, no doubt about it. But you're not seeing a lot of confidence, say, from the fertilizer sector or the petchem sector, which is they're not bringing stuff back on stream. We're back at, I think we've still got 20% of petchem and fertilizer plants basically not operating, because they don't have any confidence that gas prices are going to stay this low for a long time. And then, that's, business behavior tells you what the outlook is more like than people speculating, about, particularly the paper market. And in terms of China, I think there's two important points. The personal consumption side, the government keeps on talking about giving stimulus to try and, about, pivoting away from industrial investment to private consumption. It's talking about injecting more to, people can, what was it G said this morning? I think people can spend without worry. The fact is that the collapse in the housing market, and let's remember something: 70% of Chinese savings have basically been directed at the property market. The experience that consumers have had over the past 3 years since they started the clampdown on it has been very bad. That confidence is not coming back in any great hurry. And the other part of it is, and it's a more semantic point, or it's a more technical point, is as Europe enacts this ban on Russian oil products, the question actually is not so much will will Chinese demand pick up, but does it have the capacity in refining terms to actually fill in the gap which is going to be left by Russian by the ban on Russian distillates? I think that's something which is a little bit written in the stars. We're not quite sure. What we do know is outside of China and the new refining capacity coming on stream over the next 6 months in the Middle East, in Abu Dhabi, in Kuwait, in Dubai, there isn't actually a lot of spare capacity elsewhere. And so that just basically means that they are going to be the beneficiaries of this. And Europe will just have to pay up and look big on that front, even if at the end of the day, we can sort of debate about, well, what are they actually distilling? Is Europe actually still importing Russian product? It's not really a question of importing whether they are or they are not, and it's coming via a third direction. It's whether really the capacity constraints are still very much there, as particularly everyone has basically mentioned. The capacity constraints haven't gone away, so any pickup in demand could actually create a huge problem.
You actually brought up something that I was going to ask you about, and that is the fertilizer market, because it is very nat gas dependent. So what are you seeing there? I mean, obviously fertilizer prices have come way down, with natural gas prices way down, but do you think that do you fear we're going to see another spike this year or the following year, or is that worry over right now?
I think we're just totally vulnerable to another spike. We've been trading natural gas in Europe, particularly, and to a large extent in the States, off weather trends over the winter, which have been, relatively speaking, benign. But that can literally turn on sixpence. And I think the size of the down move, well, there's two parts to this. One is we actually haven't got power prices or natural gas prices down to the levels which pre-existed the big squeeze that we've seen over the last 2 years. Well, the squeezes plural. So that that in itself tells us, well, it tells me that in the background, in the foreground at the moment, we're focused on demand, as markets tend to be always very much demand focused rather than supply focused. And two, we also are trying to adjust. I think for a lot of people, we've had 30 years of plenty, and now we're living in a world which has moved from just in time to just in case. And this isn't an era of plenty. And even if we can lay our hands on it, at what price, and who is actually going to get the good price, which at the moment looks to be China and India, while other people basically, for moral, political, ethical reasons, basically say, well, we're just going to have to pay more to ensure that we have greater supply security. The two things aren't very comfortable bedfellows.
So higher for longer. We're not getting rid of inflation anytime soon. Take it from that one. Okay, so we'll move to, it is Fed Day, so we're like, I'm going to go to Michael, right? So everybody's talking about this new change to CPI. Can you kind of explain that to everybody and your thoughts on how that is going to affect inflation and Fed policy, rate hikes, et cetera?
I feel like Daniel might be better to talk about changes to CPI because, frankly, I don't think CPI matters that much in terms of how they calculate because we all know it's wrong anyway. Okay, so that's just to be clear on that. I'll just throw a couple of comments real quick on just where we are, sentiment and history. I get it. A lot of people are seeing the movement in commodities and saying, "Oh, this is inflationary. Powell's going to come out, whack the bulls on their head after this really strong start to the year." The challenge with that is probabilities. So it's not my opinion. Historically, FOMC weeks on average tend to have higher returns than non-FOMC weeks. There's an actual calendar effect to FOMC weeks. On average, 58% of the time, the stock market is positive to end the week on FOMC weeks. Again, that's not to say you can't have a sell-off and Powell ruining this kind of very short-term relief rally party. But you always have to kind of zoom out and think about the broader cycle dynamics, right, that are taking place. Look, I've made this point many times before, and I maintain this view. The Fed doesn't control rates. The Fed doesn't control the bond market. The bond market controls the Fed. Okay, and the fact that yields topped in October and that the bond market seems to be saying that we're in a disinflationary period or in some kind of a juncture now where maybe inflation really has peaked and we're getting back to some degree of quote unquote normalization in the relationship of inflation to the economy. The Fed's going to cue off of that, right? So I get it. A lot of noise is being made around this is the most important Fed meeting. I keep joking now on Instagram too. Most important Fed meeting until the next one. Like, I think people need to step back and just look at probabilities, look at what happened last year which was the 7th worst real return year for the S&P 500 in history, and not get too sucked into the here and now narratives, which sound really logical. The Fed's not going to allow the market to keep running higher. Nothing in markets is logical.
That's true. So I don't know, Daniel, if you wanted to.
Sorry, and just I mean, a good proof of that is what happened to natural gas and to oil. I mean, as we're talking, natural gas is still collapsing. You and I have done spaces, and all the rationale and all the reasoning and all the fundamental analysis, everything was right, was spot on. And yeah, sure, we had a warmer winter, but all these narratives, the reality is price will do what it does, independent of what anybody thinks.
I am so in agreement with Michael there. It is absolutely true. And we have to always, to demand and supply, we have to add rate hikes. And rate hikes have done a phenomenal job at taking money out of the commodity market. That's for sure. And we need to make sure that we don't collide with a rate hike path that is going to oppose the move in commodities that supply and demand might indicate. I completely agree with that. In terms of the CPI, I always joke to my students that there are 3 ways of reducing CPI: reducing aggregate demand, reducing the quantity of money in the system, or changing the way in which you calculate inflation. And that is what we're seeing right now. There is a new system that is implemented since January, in which the weight of, oh surprise, food, processed foods, and in the way in which shelter is calculated lowers the weight in the basket. So obviously that, which has been a massive component of the increase in household spending and the increase in cost of living, is going to significantly decrease the structural CPI challenges, and but it doesn't matter, to be fairly honest. The problem is that even with tweaking with the CPI basket, which will probably shed about 50, not smaller, 50 to 75 basis points out of CPI in a normal year. And obviously, another important thing is that statistical bodies never give you the same figures in harmonized for the years prior, so they never do it. They only change it, and you figure it out yourself. That's why you have to follow those shadow statistics websites. But the point I'm trying to make is that the pressure on core inflation is so elevated that even with a tweak in calculation that is going to change the way in which the weights appear, you will still likely continue to see for for a prolonged period of time those pressures in at least the basic core goods and services that we purchase. So if you look at so if you think about what the Fed is going to do, don't think about headline inflation. Think about core CPI and the trend in core CPI. To think about it, the U-turn in commodities and the U-turn in that we saw since June should have brought inflation down not to the current levels, but about 2 points lower in a normal environment. And that shows that the Fed is unlikely to change because of a weight change in the basket. It is very likely to raise rates and keep them elevated. Elevated. No, they continue to be extremely low, and keep them where they are into the end of the year, not lower, in my opinion.
Thank you for that, because obviously, like you said, matters for energy. Money flows out of the commodity markets, so what they decide is important to the commodity markets. And then I had another question. Let's bring it back to energy markets solely right now. Is I just wanted your thoughts, Daniel, on the upcoming diesel ban, the Russian diesel ban for Europe, as Europe buys mostly diesel from Russia, and what is that going to? What is that going? Are we gonna have a global diesel problem again? In other words.
Well, it's obviously another misguided decision from the European Union, because it's a big subsidy to China, which will buy the Russian crude oil, and obviously the Sinopec and other refiners are going to refine it and bring it over to Europe, the same oil at a higher price. I have been warning I said it on CNBC and I said it in other places. I have been warning about the view that this will create a shortage of diesel. In my opinion, there's not going to be a shortage of diesel. I think that it's not an issue of supply. It's going to likely be an issue of price, and that is already shown in crack spreads. But in my opinion, is that it's as misguided as the ban on Russian oil or Russian gas. Ultimately, if you want to ban something, or if you want to reduce your dependency on whatever supply you want to have in the world, what you need to do is to diversify and increase the number of alternative suppliers. What you don't do is nothing about diversification and nothing about alternative suppliers, and then ban something, because the only thing that you create is a price problem. And I think that is likely to be the case, but not a supply one. I think that there's not a problem of refining the crude oil all over the world and bringing it to Europe. It's just going to be a price issue, no?
Right. So it's just what we're seeing: global oil flows having to change, or global product flows having to change, which is not always runs that smoothly. unfortunately. So we do have a kind of a bumpy road, I think, as far as that's concerned. And we really haven't even seen the effect of, the seaborne crude oil ban from Russia yet either. So we do have that. And then I'll bring it to Mark. What are you seeing? Well, we're getting close to the end of the hour. So if you could talk about, like, what are you seeing about this Russian oil ban, and the EU obviously can't really see the effects just yet because cargoes that are still seaborne have time to until April 1st to get to port. Do you think this is going to, if we're going to see a larger effect of this, come after April, say, after cargoes have already arrived? And what kind of problems are you anticipating, or are you not anticipating?
I don't. Oh, sorry.
I think that the fundamental problem in Europe, and that was very well articulated, that Europe just doesn't seem to. This was a point which was made at the Paris Grains Conference last week, that Europe does take action, as we saw, in the immediate aftermath of the Russian invasion of Ukraine, and then suddenly all the squabbles start again. And the real fundamental problem here is that there is no European energy policy. There's a lot of disagreement on it, and no one's actually addressing the issue because no one's actually looking at it from an unemotional perspective, which basically says, how do we solve the problem? Not, these people are evil, we can't do this. Obviously there is a moral and ethical aspect to it. But at the end of the day, if you want to solve a structural problem which is of your own making, because it is very much of Europe's own making that they've shot themselves in the foot, you don't actually go around doing things which then just pile on one more problem on top of another. So I think there's definitely going to be a problem during the summer. And I think the people who are looking at the Eurozone at the moment in terms of the economy and saying we're getting some pleasant surprises, we are splitting hairs. If you look at it in GDP terms, to be honest, whether GDP is plus 0.1 or minus 0.1 does not matter. It's stall speed. And if we start getting problems with diesel again, you're just going to, the reaction from Europe, which you've seen particularly in Germany, is that people are just going to do less. So the optimism on the European economy, I think, is something which is also misplaced at the moment. And a lot of it is actually, we're talking about things which are, at the margin is a lot of whataboutery. So what? So if it's plus 0.1, it's fabulous. If it's minus 0.1, it's the end of the world. It's neither nor. And Europe still has this problem that to make the changes that it needs, it really needs to be forced into a massive, massive crisis. And that is its fundamental structural problem still, and it will carry on being, and it becomes even more so when you've got so many fragile governments in Europe, because other than the one in Italy at the moment, or all the other ones, Macron's having a pensions fight, the UK is a walking disaster area, the coalition in Germany is so much at sixes and sevens, it's not true. So getting any of them then to sit down around the table and agree with Central and Eastern Europe, which feels like it's been shortchanged in any case, is going to be a problem.
Well, that's some uplifting news, but I do tend to agree with that. As we're coming to the end, I'm going to go around to everybody and just ask your final thoughts, and if there is anything that we didn't cover that you would like to cover, and anything that sort of we haven't talked about that we may be missing looking forward into 2023 as far as energy markets are concerned. So, Michael?
I mean, I think the major thing is the longer term secular dynamic remains positive because of all the underinvestment, which has been well covered all throughout last year. But it's going to be bumpy, and again, if you're not a big fan of investing in emerging markets, it's the same kind of trade to invest in commodities or to invest in value over growth or to invest in energy over tech. These are all variations from an intermarket perspective on the same concepts. And by the way, everyone should follow that's listening to this. Should follow every single person here. I hear if you follow Daniel Lakai, especially, that he might actually send you one of his 30,000 albums. So be sure you also follow Daniel, the Place Your Trades account, Tracy, Mark, everybody else, and hopefully me. But that's it on my end. I appreciate the invite.
Thank you, definitely. Daniel, your final thoughts and anything that we should be looking at going forward that we haven't really discussed?
Certainly. To start with, thank you very much, Michael. Second, the most important thing to look out for is I'm not giving away any album. Anyway, apart from that, I think that we need to I think that we need to monitor what's going on in Asia to see the extent of the Chinese reopening. We are paying a lot of attention to the increase in exports from other Asian countries that trade with China, to to try to gauge whether the trend that the market is currently discounting is actually a reality or whether it's all a mirage based on optimistic views about the reopening. So pay attention to that. The other thing I don't see in there's only one point I wanted to make. Central banks know that the only way in which inflation is going to come down to 2% or similar is going to be with a massive decrease in aggregate demand. But governments that weigh between 40 to 60% of GDP all over the developed economies are not going to reduce their expenditure. Therefore, the global aggregate demand reduction can only come from a massive slump in the private sector. So if you are betting on rate cuts into the second half of the year, you're basically not betting on a recession. You're betting on a big slump in private sector demand, and that would certainly not be bullish for equity or bond markets. So actually, I think that those that are betting on cyclicals because there might be some rate cuts in the second half are actually betting against themselves.
Very counterintuitive to what most would think. I think those are excellent comments. And Mark, your final thoughts. Again, same question. Anything that we didn't cover today that you think is important and that we should be looking forward to throughout the year as far as the energy markets are concerned?
Well, I think the underinvestment story is an important one, and we probably aren't paying enough attention to the reports from the oil majors and even the second tier producers, because to me, the more we see them doing buybacks, the more that the prospects for improving what's been an investment deficit basically go downhill. Reassuringly, Exxon didn't increase its share buybacks yesterday. So that on the one hand is a positive, but the benefits of it are, they only accrue in the very, very long term. And to my way of thinking, the part of the world that we really need to be actually keeping a close eye on is what I call the non-aligned group, particularly the group around India and the GCC, the Gulf Cooperation Council countries, because I think what happens there, along with what benefits accrue to Southeast Asia, above all from China recovering, are going to dictate how well the global economy does. I think the problems in Europe are not going away, and that's just simply a fact that which we're going to have to deal with. So what I expect is people to, we're going to have another choppy year for energy prices, but it won't be as wide a range as last year. On the other hand, it may be more violent in terms of the movements simply because the underlying liquidity in markets is getting poor. And in all of this, we also have this added problem is the world's debt is all mostly denominated in dollars. So if we start to have more of a credit problem going into the demand for dollars could be enormous. And that's going to obviously have a spillover into not only just energy, but all commodity prices.
Very well said. So I have a million other questions, but I've taken enough of your time today. So I want to thank everybody for giving us your time today. I really appreciate it. I think everybody should follow all of these speakers. They all have great Twitter accounts and great information on their Twitter on their Twitter streams. Also follow Place Your Trades. Unfortunately, Yra had problems getting on, but I will have him rescheduled for another week if he's not too frustrated. So again, thank you, everybody. Thanks, everybody, for attending. Thank you to our speakers. Follow everybody up there, and I will see you guys next Wednesday.